Some of the country's largest superannuation funds underperformed last financial year, but the returns are still pretty good. Retail sales rise, but only because stores are discounting to win customers. And US President Joe Biden under growing pressure to not run again. Welcome to Fear and Greed, daily business news for people who make their own decisions. It is Thursday, the 4th of July, 2024. I'm Michael Thompson, and good morning, Sean Aylmer.
Good morning, Michael.
Sean, the main story this morning, the superannuation funds are announcing their performance over the last financial year, and some of the biggest funds aren't at the top of the rankings.
According to Chart West, the median return for the last financial year is forecast to be about 9% plus, so that's the benchmark. Australian Super, the country's biggest super fund, delivered an 8.5% return in its balanced option, which is the default options for new members. The result reflects the decision to become defensive around equities early in the financial year, meaning the fund missed some of the run on US tech stocks, specifically Nvidia. It's still a pretty good return, mind you, and well above the fund's goal of CPI plus 4%. The Australian Retirement Trust said its My Super option, which is the default fund, returned 11.3%. That was very good, while Hester's My Super option returned 9.1%. There's no doubt super returns have done very well in 2024 financial year. There is 3.9 trillion with a T, trillion dollars in super accounts across the country. That's at the end of March. It's the second largest asset class behind property. The amount being contributed by everyone into their fund increased from July 1 from 11% to 11.5%. So it's certainly big business. All of us are affected by it. And so while some of the biggest, Aussie Super, for example, may not quite have achieved the median, still not bad.
So that's what happened last year. Sean, what about this year? I suppose the big question is, can the super funds repeat the performance of not just last year, but also the year before, where the median fund also came in around 9%? Can they go for 3?
Yeah, the three-peat. Let's hope so. That would be a pretty good effort. In Australian Super's case, Chief Investment Officer Mark Delaney realised that equities markets weren't going to tumble late last year and started buying stocks. He's now slightly overweight equities. Remember, when we were talking about these super funds, they are talking about billions of dollars here. So overweight, they may only be slightly overweight, but that's still a fair chunk of money there. Mr. Delaney told the Financial Review that the last 2 years have been so good that he thinks something has to give. About 73% of Australian Super's balanced fund is in publicly traded assets, equities, bonds, cash. The rest is in private markets. Now, UniSuper's Chief Investment Officer John Pearce told the Fin Review that tech stocks and the Commonwealth Bank shares are overvalued, but he conceded it's tough to call and even harder for long-term investors who will have to eventually buy back in how they should value these big tech stocks and the Commonwealth Bank. His quote, "You're going to have to live with overvalued assets." In UniSuper's case, it's increased its allocation to private credit. It's been a fan of bonds as well, some tier 2 bank bonds. I think the best way to sum it up is the CIOs of these big super funds are entering the new financial year with some trepidation, to say the least.
So asking you to predict what the results would be this year when we are only, 3 days in now, was probably asking a little bit much.
Yeah, I thought I talked my way around it quite well, but you did bring out the obvious, i.e. I didn't answer the question. Who knows? Who knows?
But Sean, you have given me the perfect segue and the perfect opportunity to promote our bonus episode that we have coming up later today, probably around about lunchtime, maybe some good lunchtime listening. It is our new episode that we put out a couple of times a week called Ask Fear and Greed, where if a listener has a question, send it in to us via fearandgreed.com.au or any of the social media platforms. And if there's something that's been bugging you about the economy or about business or about shares or anything, let's try and stump Sean. Actually, no, that's unkind, isn't it, Sean? But we've got a great question coming up today. It is about economics, and we are going to put that one out, and it's only 3 or 4 minutes, isn't it? So it's just a short, sharp little injection of knowledge into your day.
Yeah, exactly.
So keep an eye out for that one, probably about midday today. Now, local markets, how do they perform yesterday?
The S&P ASX 200 closed up 0.3% to 7,740 points, with the tech stocks leading the way thanks to a stronger night on Wall Street. WiseTech Global reversed some of the previous session's losses, finishing up nearly 2%. Xero also did well. Good day for many of the miners. The best on the bourse, for at least of the top 200, was uranium stock Deep Yellow, while the energy stocks did well. BHP, Fortescue Metals and Rio all closed up 1% or better. Worst was Liontown Resources, and that was the best on Tuesday, so there's a bit of profit taking going on yesterday. The big banks were all lower. In corporate news, online book retailer Booktopia has been placed in voluntary administration. Shares will remain suspended after they were halted in mid-June as the company searched for more funding. And APA Group, its share price fell after it said it expected a non-cash impairment of $145 million to its Moomba Sydney ethane pipeline.
And what about international markets?
The broad-based S&P 500 closed above 5,500 points yesterday. That was the first time that's ever happened. It was pushed higher by tech stocks, notably Tesla. That finished up 10%. More on that later in the show. The tech-heavy NASDAQ also finished at a record above 18,000 points for the first time. It all came after the US Federal Reserve Chair Jerome Powell said he'd seen some really good progress in a recent decline in the Fed's preferred measure of inflation. Moving to commodity markets, oil prices remain on an upwards trend, with Brent fetching close to $87 a barrel. Gold's also trading higher, around $23.30 an ounce. That's $2,330 an ounce, Michael, not $23.30, of course.
I thought, here we go. We've got a bargain here, Sean.
Get in there. Iron ore prices earlier in the month were forecast to drop below $100 a tonne. They've shown some great resilience. They're trading around $108 a tonne, obviously good for the Aussie exporters. In currency markets, Bitcoin is worth under $61,000 a unit, and the Aussie dollar is buying 66.8 US cents, a massive 0.1 US cent increase in 24 hours. And in fact, I think it's a 0.2 US cent increase in the last 3 days.
Oh, it's really cutting loose for the new financial year, isn't it? Oh, God, the thrills and the Aussie dollar. Currency.
Oh, my word.
It's giving me the vapours, Sean. All right, we'll be back in a moment with the rest of the day's business news. Sean, Prime Minister Anthony Albanese has told Parliament he expects Fatima Payman to quit the Labor Party in coming days.
Amid expectations that the rebel senator will move to the crossbench with the backing of Muslim groups, he said the plan had been in train for more than a month. Senator Payman crossed the floor last week to support a Greens motion to recognise the state of Palestine. That, and her subsequent refusal to abide by party rules, resulted in her indefinite suspension from the caucus. Mr Albanese has met with Senator Payman on 2 separate occasions to discuss her future in the Labor Party, and has repeatedly maintained that he hoped she would return to caucus. It doesn't sound like that's going to happen.
No, it's looking a little unlikely. Now, retail sales jumped 0.6% in May, though most of that was on the back of discounting by retailers.
It was actually a pretty good number. Now, it's a number that I reckon Stephen Kakoulis would have liked, our resident economist, on the show every Monday morning. I reckon he would have liked it until he actually looked at the details. Then maybe not.
Yeah, you should just do what I do, just look at the headline. The details depress me, Sean.
Yes, very true, and sometimes tedious. Basically, shoppers took advantage of early end of financial year promotions and sales, according to the Australian Bureau of Statistics. Retailers continue to rely on discounting and sales events to encourage shoppers to spend, i.e. they're not getting what they really want to get for the products they're selling. While seasonally adjusted spending rose, underlying spending was actually stagnant. Compared to a year ago, the trend is only up 1.5%. Retailers are working very hard to boost sales at the moment, and we know that from a spate of companies who have warned shareholders about soft turnover. AMP's chief economist Shane Oliver yesterday said we're in the midst of the worst retail recession we've seen in the history of the data, both in terms of length and magnitude. What's going to be really interesting, of course, is what happens to retail sales this month, now that the stage 3 tax cuts have kicked in.
And staying in the economics world, Sean, there was a welcome jump in dwelling approvals in May.
Yes, though only a little.
See, again, I offer kind of a bit of positivity.
Yeah.
Good retail sales number, good jump in dwelling approvals, and then you come in with the big but.
Economists are known as the dismal scientists, remember that.
Yes, well, you are certainly proving that to be true. Go on.
Now, these numbers jump around a fair bit. Keep that in mind. But approvals rose 5.5% in May, following a near 2% jump in April. The increase in May was driven by a big rise in approvals for apartments, townhouses, that sort of stuff, not so much for houses. Approvals were up most in Western Australia, then Queensland, South Australia, Tasmania, and New South Wales. Given the slump in the building industry in recent years, any good news in terms of building approvals is very welcome. But the pace of approvals is now running at only 161,000 dwellings per annum. The peak during the apartment building boom in 2016 was about 240,000 per annum. Underlying demand is about 250,000 per annum on AMP estimates. This chronic undersupply of housing remains a big problem for the economy, and it will also keep pressure on prices and rents.
Tech giant Google will likely face increased competition for search services on Android devices following undertakings by telco giants Telstra and Optus to the competition regulator.
Really interesting. This, the Australian Competition and Consumer Commission's ongoing investigation into Google's search services in Australia led to it discovering agreements the tech group entered into with Telstra and Optus a few years back. Under the deals, Google's search service was installed as the default service on Android devices the company supplied to customers in return for a share of its advertising revenue. Google, which developed the Android operating system, have had the agreement since at least 2017, according to a report in The Australian. The deals limited the ability for rival search engines to be pre-installed or promoted on Android devices. Now, the agreements expired on June 30. Both telcos have now told the ACCC that they won't renew or enter into any similar arrangements with Google. The ACCC has found that there are strong consumer biases towards default settings on mobile devices. Google's search market share is about 98%. Now, the ACCC is trying to take action to ensure that these preloaded services aren't skewing the market.
And finally, Sean, the electronics design software group Altium looks set to leave the ASX after US authorities okayed a takeover by a Japanese semiconductor company. Why are the US authorities okaying this one?
Because it's based in San Diego, listed here. Now, the company received a $9.1 billion offer from a group called Renesas Electronics. That offer is why Altium is one of the best performing stocks last financial year. Now, the board of Altium has recommended the bid. It actually had to go to competition authorities in a bunch of jurisdictions where it operates. So here in Australia, in the US, in Germany, and Turkey, they've all now approved the proposal. Shareholders meet on 12 July to vote on the deal, but it should pass, thereby taking yet another company off the ASX.
Oh, this is really becoming a trend, isn't it?
It certainly is.
After the show, Sean, quick mention of this one. You have an interview coming up today with Stuart Price, who is the CEO of CASL, one of Australia's leading litigation funders. This is an interesting space.
So we were sitting around talking about who would be interesting to be on the show, and we kind of got this conversation going, you, me, and Adam Lang, our wonderful esteemed colleague who is our judge on our weekend edition. If you haven't listened to the weekend edition, you'll understand why I'm saying wonderful esteemed
Could
colleague.
You be any more sarcastic? You are still bitter about the lashing I gave you.
Yes, probably. Anyway, we're talking about asset classes that we don't talk much about. And litigation funding is a really interesting asset class. It gets a bit of a bad rap. But in actual fact, when we talk to Stuart, as he puts it, what we're trying to do, we raise money and we take on the fight that individuals probably couldn't afford to take on themselves, and they have an incredible success rate. There's all sorts of hoops they jump through before they decide to take on a case, a class action primarily, and investors invest money and then get a return on that. It's just a really interesting chat about how that whole world works.
Yeah, it is a good one. It is coming up after the show, so stick around for that. In international news, Sean, Joe Biden is under increasing pressure to drop out of the presidential race after a Democratic congressman from Texas called on him to drop out, and state governors sought a White House meeting to discuss his candidacy. This is not looking good.
No, Lloyd Doggett, which is a cracking name, Doggett, Lloyd Doggett.
He sounds like a movie character.
Or someone who probably should be the first person from the president's own party to publicly call for him to step down.
If I didn't know he was from Texas, I would say he's from Texas.
Yep, well, you're right. Basically, Mr. Doggett said there's too much at stake to risk a Donald Trump victory in November's election. Also, a Democratic congressman from Maine said he had no confidence in Joe Biden's ability to win the election, while another from Washington state said she thought Mr. Biden's performance in last week's debate had cost him the election. The concern among Democrats, including state governors who are reportedly gathering in Washington, D.C., is Joe Biden's age and fitness. The Supreme Court decision this week, which gives the president legal immunity when acting in an official capacity, has actually rallied Democrats who are very fearful that Donald Trump, if elected, would actually abuse that right. Joe Biden said his performance in the debate last week reflected his travel schedule ahead of the two meeting, though he did actually spend the week immediately before last Thursday's debate at Camp David preparing, so I don't know how that flies. Anyway, a lot of noise about the place, even you would say momentum growing, to try and convince Joe Biden to step down.
Yeah, it sounds like it. And while we're still in US politics, Sean, Donald Trump's sentencing hearing in the Manhattan hush money case has been pushed back to mid-September. The Manhattan hush money case sounds like a Hardy Boys mystery.
Oh, yeah, it does, doesn't it? That's pretty good.
Yeah.
But you digress.
I do.
So Mr. Trump, who's the first former president to be convicted of a crime, was set to be sentenced in a week's time. But following that Supreme Court ruling last week, lawyers for Mr. Trump wrote to Justice Juan Merchan, who oversaw the Manhattan hush money case, and asked for more time to appeal the verdict. They argued that some of the evidence used at trial, including social media posts and public statements, might have been official acts and therefore inadmissible under the Supreme Court's decision. So we can already see the implications of that decision earlier in the week.
Now, Sean, you mentioned Tesla earlier in the show. The share price for the EV maker jumped 10% after the company reported a second consecutive quarterly drop in deliveries on the back of slowing demand and tough competition from cheaper Chinese rivals.
But, Michael, the good news, you're complaining about me always giving you the bad news, the slowdown is less than expected, hence the surge in Tesla's share price. The company stock is now up 35% since June 11. Full of good news.
You're full of something.
Mind you, the value of the company is still around 60% of its peak. That was back in November 2021. Full of something. I've been thrown here. Anyway.
Sorry. I'll sit down.
Tesla delivered 444,000 vehicles in the 3 months to the end of June. It's back as number one EV maker in the world after China's BYD said it delivered 426,000 vehicles in that same period. That was further good news for Mr. Musk. He's had a pretty good few weeks. Shareholders recently reapproved his $56 billion pay packet that had been struck down by a Delaware court. They also agreed to move the company to Texas. It's being repositioned as a robotics and AI company. They came out and said the robo-taxi is supposed to be unveiled on August 8. Elon Musk's having a good run, really.
Yeah, there is a lot going on for him. One more, Sean. One last story. Google's greenhouse gas emissions. This is from Google, right? The greenhouse gas emissions of the company have surged 48% in the past 5 years due to the expansion of its data centers that underpin artificial intelligence systems, things like that.
The tech giant's commitment to get to net zero by 2030 is now definitely in doubt, and the dilemma very much highlights a less beneficial consequence of the growth of cloud computing and artificial intelligence, basically the huge demand for power. Google's pollution amounted to 14.3 million tonnes of carbon equivalent last year, which is 48% more than its 2019 baseline and a 13% rise since the previous year. According to a report in the Financial Times, the tech giant said the future environmental impact of AI was complex and difficult to predict. It's now calling its 2030 target of net zero extremely ambitious. Mind you, it did add, which I liked in its statement, that there is a tremendous opportunity for climate solutions that are enabled by AI. Maybe, but I hope they get there.
Up next, Fear and Greed Daily interview. Your guest today, as we mentioned, Stuart Price from CASL, one of Australia's litigation funders. Fascinating stuff.
Yeah, all about investing in litigation funding and the sorts of returns that it's providing. It is as you say, it's a very interesting chat.
Yeah, sure is. It is up next in the Fear and Greed playlist on your podcast platform or at fearandgreed.com.au. And Sean, I forgot to mention yesterday that the new episode of How Do They Afford That is out. well, now. It is our sister podcast featuring me and financial planner Canna Campbell. And this time we were joined in the studio by a man named Adam McCabe, who is a mortgage broker. And he was actually talking about the likelihood that, look, if interest rates do actually go up again, potentially as soon as August, that there are some things that you can do to kind of prepare best for that. And they include conversations with your bank, conversations with a mortgage broker, and some things that you can do to try and lessen the impact of a potential rate hike. It is worth a listen. I'll put a link in today's show notes, and you can find How Do They Afford That wherever you listen to podcasts as well. Thank you, Sean.
Thank you, Michael.
It is Thursday, the 4th of July, 2024. Make sure you're following the podcast, and please join us online on LinkedIn, Instagram, X, TikTok, and Facebook. I'm Michael Thompson, and that was Fear and Greed. Have a great day.